A few days ago, a story surfaced online that made a lot of people uncomfortable. Not because it was shocking in a loud way, but because it was quietly disturbing. A 90-year-old man had been sold a life insurance policy with an annual premium of 2 lakh rupees. The policy was structured to mature in the year 2124. Yes, 2124, a full century from now. The man had been banking with the same branch for decades. He trusted the people there. Now that trust became the foundation on which the sale happened, and according to the family, the policy was pitched as urgent and very important. Money was deducted directly from a savings account twice. By the time the family noticed, 4 lakh rupees of his lifetime savings had already gone into premiums for a policy that he never truly understood. Now, what made the situation worse was the structure of the policy itself. The elderly man was the one paying the premiums, fine, but someone else in the family was listed as a life assured. This arrangement, the family alleged, was used to work around age limits that would normally apply to buying such a policy. Documents were filled in by the bank itself, signatures were taken, there were no independent explanations, no cooling of clarity, there was actually no real understanding on the customer's side. Only when an alert for the next premium came in did the man panic and call his family. That's when they realized what had actually happened. Now, after public pressure, the issue was resolved and the money is expected to be refunded. But that's not the point. The real issue is this. This was not a scam pulled off by a stranger. This actually happened inside a system that people are told to trust blindly. And it happened to someone who was clearly vulnerable. So let's slow down and unpack what actually went wrong here, because this isn't an isolated incident. Variations of this happens far more often than people realize. The first and biggest problem was age-appropriate selling. See, life insurance is designed to protect income. Once someone is 80 or 90 years old, there is no future income to protect. Selling a long-term life insurance policy at that stage actually serves no financial purpose for the buyer. Even if paperwork technically allows it, suitability matters. A product being sellable does not mean it is suitable. Now, the second issue was pressure-based selling. Words like urgent, very important, are classic red flags. A good financial product doesn't need urgency. Insurance decisions should survive a night's sleep, a second opinion, and a family's discussion. If something is being rushed, it's usually because it benefits the seller more than the buyer. The third issue was complex structuring that the buyer could not reasonably understand. Listing one person as the life assured and another as the premium payer is not illegal by itself, but when the premium payer is elderly, dependent, or unaware of long-term implications, especially when documents are filled in on their behalf. The fourth issue was lack of informed consent. Consent is not a signature. Consent means understanding what you are buying, why you are buying, and how long the money is locked in, and what you got in return. A policy maturing 100 years later fails this test instantly. Now, this brings us to the most important question. How do you make sure this never happens to you or your parents? First, no insurance decision should ever be made alone for senior citizens. If a parent or grandparent is being sold a financial product, at least one other family member must be involved. Not informed later, involved before the money leaves the account. Second, never buy insurance inside a bank branch without independent verification. See, banks are distribution points, but they're not fiduciaries. Their role is to sell, not to judge suitably. Always ask for policy brochure, the benefit illustration, or at least 24 hours to review it outside the branch. They can't force you. Third, check 3 basics before saying yes: entry age, policy tenure, and maturity age. If the maturity age is something the buyer will never realistically reach, that product is unsuitable. Full stop. Fourth, be extremely cautious with words like guaranteed, safe, urgent, high returns. Now, these are sales words and they are not planning words. Good insurance planning sounds boring. It feels slow. Now, that's a feature, it's not a bug. Fifth, remember that senior citizens rarely need life insurance. What they usually need is good health insurance, liquidity, and protection from financial stress. Life insurance at that age often exists to meet sales targets, not real needs. Sixth, know that mis-selling can be reversed if caught early. There is a free look period, there are escalation channels, there are regulators, but all of that only works if families are alert and involved. Finally, and this is the most important point, never confuse trust with blind acceptance. Long relationships with banks, agents, or institutions do not replace due diligence. Trust should make conversations easier and not eliminate questions. So, folks, this story did end with a refund. Many others don't. The real cost of mis-selling isn't just money, it's actually anxiety, loss of dignity, and the feeling of being played and taken advantage of when you're least equipped to fight back. If you're ever unsure whether a policy makes sense, especially for a parent or senior family member, pause, get a second opinion, ask someone who doesn't earn a commission from your decision. Now, that single step can save you years of regrets and lakhs of rupees. Folks, insurance is meant to reduce stress and not create it, and if a product doesn't do that, it doesn't belong in your life.